Hi, I'm Dave Nolan, Senior Investment Strategist at McKinley Carter Wealth Services, and today I'd like to highlight our first quarter market review and investment outlook report. In our fourth quarter Huddle newsletter investment report entitled, "Elvis Has Left the Building, Has the Fed Declared Mission Accomplished?" we stated that we believe the Federal Reserve had ended their rate hiking cycle. We also stated that as long as we continue to get positive news regarding our three pillars of the investment landscape, inflation, interest rates, and corporate earnings, we believe that both the stock and bond markets could deliver modest growth in the first quarter of the year. Indeed, in the first quarter, the S&P 500 rose over 10% and foreign stocks rose 5%, but bonds did lose 0.8% as interest rates backed up a bit. As we look at our three investment pillars today for clues about future market returns, we find that while S&P earnings continue to beat expectations due to the influence of tech companies, inflation and interest rate data have become less of a tailwind for stocks of late. Regarding inflation trends in the first quarter, both CPI and the Federal Reserve's favorite inflation gauge, the Core Personal Consumption Expenditure, or PCE index, reported mixed results. Recent data have shown that the last mile of declining inflation, reaching the Federal Reserve's ultimate target of 2%, may be a challenging one. Encouragingly, despite the recent rise in the three-month rate of core PCE, which excludes volatile food and energy prices, the year-over-year rate declined to a multi-year low of 2.8%. We continue to monitor inflation very closely as market expectations are for persistent easing in inflation trends, which then contributes to moderating interest rates and ongoing support for stock prices. The short-term interest rates controlled by the Fed are expected to fall in the second half of 2024. The CME FedWatch tool that tracks the probability of the Fed funds rate being within specific ranges on specific dates currently forecasts less than a 2% chance that the current high level of rates will still be in place at the end of the year. Recently, though, less positive inflation data combined with strong economic trends have brought into question how soon the Fed will announce the first rate cut. This year, bond investors have demanded higher rates on their new bond purchases due to inflation and economic data released in January and February. This can be seen in the increase in the yield on the 10-year Treasury bond, which has moved back above the 4.4% level, well beyond the 3.9% rate seen at the end of 2023. This increase in rates has led to negative fixed income returns year to date and may serve as a stumbling block to higher stock prices, especially growth stocks, which tend to perform better in a lower rate environment. On the earnings front, the total S&P 500 earnings for the first quarter of 2024 are expected to be up over 2% from the same period last year on over 3.5% higher revenues. This follows the 6% earnings growth on 4% higher revenues in the fourth quarter of 2023. As was the case in the preceding two quarters, the tech sector remains a key growth driver for overall earnings. Had it not been for the robust tech sector growth, total earnings for the rest of the index would be modestly in negative territory. Despite this negative outlook from the non-tech part of the market, the good news is that future quarters are expected to reverse this trend, with earnings leadership broadening out to other sectors. As part of this year's earnings growth is expected to come from profit margins reversing last year's declines and starting to expand again. The expectation is that profit margins this year get back to the 2022 level, with the tech sector driving most of the gains. Looking at the calendar year picture, total S&P 500 earnings are expected to grow over 8% this year after last year's modest decline. 2025 is projected to be even a better year for earnings growth, with large cap, small cap, and international estimates all quite strong. Despite some near-term challenges, namely sticky inflation data and the rising longer-term interest rates, our three pillars are expected to provide support for markets over the course of 2024. Thank you for watching today, and please read our full market review and investment outlook report for greater detail on the first quarter and our forecast for the rest of the year. Take care, and we'll see you next time.